Hello everyone, welcome back to our channel. In order to understand how a particular country financial landscape has been structured, it is important to understand the decisions taken by Central Bank Monetary Policy Committee for that particular country. In this video, we are going to deep dive into Central Bank Monetary Policy Committee decisions for India. So let's get started. Number one is repo rate. The committee has decided to keep the repo rate at 6.5% only. But what is repo rate? It is the rate at which RBI lends to other banks. This rate actually influences the borrowing and lending rates in the economy. Number two is inflation. When here is something different. The RBI wants to keep inflation rate at 4%, but it has revised its expectation for inflation from 5.1% to 5.4% due to several factors. Let us try to bifurcate these factors and try to understand this in an easier way. The number one factor is increase in global food prices. Even the food price index has itself rising. Food price index is a measure of the monthly change in international prices of a basket of food commodities. It consists of the average of 5 commodity group prices indices weighted by the average export share of each of the meats over 2014 to 2016. Now why exactly this food price index has risen? This food price index has risen because of the increase in the price of vegetable oil, as well as the decision taken by the oil-producing countries like Russia and Saudi Arabia, which actually influence the crude oil production. Another reason for this increase in food price index is the price of various food items, such as tomatoes, onions, pulses, cereals, and milk, have also gone up in India. To address this, government has taken several steps, like more wheat and rice into the market and impose restriction on the rice export, but still the prices of these items have actually increased, which is leading to increase in food price index. Another thing to note over here is the projection made by RBI actually depends on the monsoon. So if the monsoon changes, then these projections related to inflation can also change. The good thing is RBI has actually kept its growth forecast to 6.5% for the economy. Even when the global challenges are actually hitting the economy, RBI still sees the robust economic activities taking place in the economy. Sectors like cement and steel are actually experiencing high growth. There has been an increase in tractor sales altogether and electricity generation, while there has been a slowdown in passenger car sales and bank credit, but the bank credit still remain robust. The fourth factor about which Monetary Policy Committee talks is incremental cash reserve ratio. Incremental cash reserve ratio is only introduced to actually take away the surplus liquidity existing in the economy. But what exactly incremental cash reserve ratio is? So it is similar to cash reserve ratio, where banks have to deposit certain amount of money with RBI. But the catch over here is the bank does not receive any interest on this amount of deposit. The incremental cash reserve ratio was not introduced after demonetization, but RBI has actually introduced it to reduce liquidity from the system and to control inflation. Now, with all these strategies into place, in the coming days we are going to see how exactly Indian economy landscape will change. Well, that is all for this video. If you find this video insightful, hit the like button, subscribe to our channel, and press the notification bell. We will see you with more deep dives in the coming days. Thanks for watching. Take care.